Leverage is borrowing funds in order to expand or invest is referred to as leverage. So it basically means that you are borrowing fund in order to invest in somewhere and expecting that you get a higher return that you don't get by investing in any other areas. So basically it's a kind of debt. You're borrowing funds to invest on somewhere and expecting that your invested return on invested capital is higher. Let's see how normal deal works in real world. Suppose the gentleman you're looking at your mirror has $10,000 in hand. With this $10,000, he is buying a box of something that he can sell later on. So suppose that he has bought a box for $10,000 and has sold it for $11,000 and making $1,000 profit. It's a good deal, right? But you'll change your mind when you see that how leverage works and how profitable it is. Suppose the man has $10,000 in his hand and he's not buying a box in this time. Actually, he's borrowing more funds. So, for say he's borrowing $990,000 more, and in total he has $1 million in his hand right now. So, with this $1 million, he's buying 100 boxes. And he's selling those boxes for $1,100,000. Okay, now it's time to pay back the amount that he borrowed, which is $990,000. And with this $990,000 amount, he has to pay add the interest payment, right? Suppose the interest after calculating the interest rate, the interest has come 10,000. So with this $990,000, he has to pay 10,000 more. That means 1 million. So his profit will be 1,100,000 minus 990,000 minus 10,000 interest minus the 10,000 that initially he had in his hand. The profit amount is 90,000, which is huge, right? So you can see that how he could make profit in the normal deal like 1,000. So compared to 1,000, leverage works really fine, right? So you can say that it's a bad deal. The usual deal is a bad deal compared to leverage. Now it's time to see the type of leverage. There are three types of leverage: financial leverage, operating leverage, and combined leverage. Let's see what is financial leverage. Financial leverage is the use of borrowed money debt to finance the purchase of assets with the expectation that the income or capital gain from the new asset will exceed the cost of borrowing. Okay, but when the financial leverage is really high, then this may lead the company to default risk and credit crisis. Okay, operating leverage. Operating leverage applies the concept of leverage to the cost of providing goods and services. Operating leverage is the ratio of fixed costs to variable costs. A capital-intensive firm with high operating leverage is sensitive to sales. Now, you might ask the question that what is a capital-intensive firm? If a business firm has more fixed costs as compared to variable costs, then the firm is said as capital-intensive firm. So this kind of firm has with high operating leverage is sensitive to sales. A small change in sales volume can result in large change in return on invested capital. Okay, remember that. Combined leverage is the operating leverage which measures fixed costs and assets with the debt financing measured by financial leverage. So basically this is the combination of financial leverage and operating leverage. That's all, and it's time to subscribe Business School of IR and be a smart man and rich man by knowing that how to finance and where to finance, or I will leave a zombie behind you. Choice is yours.